Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today, either on Cable TV 10 in New Bern or 94.1 FM WNBU. We've got a great show planned for you today. A lot of our topics for the show come from our viewers and listeners like you. So if you would like to hear us talk about a particular topic, feel free to email us at allthingsmoney@dlblain.com. Give us a call at 252-633-0107. And of course, you can always visit us on the web at www.dlblain.com. There you'll find information about myself, my firm, as well as archived copies of the show. In fact, today we're going to start off with a little bit about the federal government TSP or thrift savings plan. We have a lot of people in the local Craven County that work for the federal government at Cherry Point, and so we thought we would give them some information on some very unique financial planning, retirement opportunities that they have. The number one being the Thrift Savings Plan, or TSP. And so I'm going to give a little overview of that and how it works. We definitely recommend that all government employees participate in this. There would be very limited exception of someone that we would not recommend that participate in this, especially up to a 5% match. The TSP is like a 401k, if you've heard of a 401k. It's where an employee defers part of his salary. So if you make, say, $50,000 a year and you decide to defer $5,000 a year, it means you only get paid $45,000, and $5,000 goes into this investment account, which grows tax deferred. You can start to withdraw at age 59 and a half, tax-free. Penalty-free. You will pay the income tax at that point. But in the current year, instead of paying income tax on the $50,000 that you make, you only pay income tax on the $45,000, not the amount that you defer into the savings plan. Now, one of the real big benefits with the federal TSP is the matching program. Even if you put nothing in, there is an automatic 1% match given by the federal government. And so 1% of your base salary is automatically put in your TSP whether you contribute or not. They will also match up to an additional 4% for a total match of 5%. So if you put in 5%, the federal government will put in 5%. So going back to our example, if you make $50,000 a year and you defer 5% or $2,500, the federal government will put in $2,500 of their own money, of the taxpayers' money, and so your account balance will be $5,000, even though you only put in $2,500. So we definitely recommend that at a minimum you want to defer up to 5% so that you can get all the match. It's essentially what I call free money, and there really has to be some unusual circumstance for you not to take that free money. It's tax deductible, grows tax free, and you get a match. It's a definite win-win. So once you have money in this TSP, well, what do you do with it? There in the government TSP, there are several options: the G fund, the F fund, the C fund, the S fund, the I fund, and the L fund. So there's basically 6 options. They try to make it easy. By default, if you don't make a choice, all of your money will go into the G fund. The G fund is a government securities fund, and we're going to get into that a little bit more. It's a special fund that invests in U.S. Treasuries that are specially issued by the Treasury to the TSP. So when you invest in the G fund, it's essentially U.S. Treasuries. The F fund is designed to match the Barclays U.S. Government Bond Aggregate Index. So it will have government, corporate, and mortgage-backed bonds in it. The C fund is designed to match the returns of the S&P 500 index. The S fund is designed to replicate smaller and medium sized companies within the U.S. The I fund invests overseas in Europe, Asia, and Far East. And the L funds are a combination of the G, F, C, S, and I funds based on when you will need the money. So that's kind of a brief overview. I also covered these funds in order of ascending risk. So the G fund is considered the most risk-free. Now, it does invest in U.S. government securities, and if you're concerned about the viability of the U.S. Government meeting its debt obligations, then you may not consider it the safest, but it is still, in the financial community, considered the safest investment. Then the F fund, you're investing in bonds, you're mostly making an interest income. Then the C, S, and I fund are stock funds, and they invest in the stock market both here in the U.S. and globally. Within the L funds, they have an L income fund, an L 2020, an L 2030, an L 2040, and an L 2050. And they try to make it easy for you. You just select the date. For example, if you need the income now, you would select the L income fund. If you need your money sometime in, say, 2045, you would select the L 2040 fund. And that you get a pre-made mix of all the different funds available that adjust as you get older. And so if you don't want to spend a lot of time looking at this or analyzing the choices, the L funds are a decent option. Of note, though, the TSP is severely lacking in its choices. They're missing major asset classes that we think over time are critical. Number one, it has no international bonds. They have no TIPS or inflation-protected securities. There's no commodities. There's no real estate. And there's no emerging markets. There's no high-yield bonds. There's no emerging market bonds. So there's several asset classes that are missing, although it does cover the basics of your bonds, U.S. stocks, and foreign stocks. It's missing a lot of asset classes. So we think that you also need to be saving money outside of the TSP in order to develop a well-diversified portfolio. So all in all, the TSP is a great start. Just remember to defer at least 5% of your base salary so you can get the full benefit of the 5% match. Then select amongst the G, F, C, S, and I funds according to your risk tolerance and your time horizon. Or if you're not sure what that means, just pick one of the L funds that correspond most closely to when you will actually need the income. And then remember to make sure that you're saving outside of the TSP because it does not have enough investment options to fully develop a diversified portfolio. There have been some concerns about the G fund, and we'll talk about that after our short break here. So for All Things Money, I'm David Blain, your host, and we'll be right back after a few short messages.